Hey everybody, welcome to this free edition of our Trader Use Group for the trading week ending September 22nd, 2023. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is dot plot turmoil, but this was to be expected. Let's get into the week and just kind of see what I'm talking about when I refer to dot plot turmoil. If we take a look at this past week, you can see it was really not a very pretty one. Everybody was solidly in the red. Year to date, everybody's in the green, just barely for the Russell and the Dow. S&P at 12.5%. NASDAQ up a little over 26%. But basically, most investors reacted to a hawkish forecast from the Feds this last meeting this past week. We saw a rise in Treasury yields. In fact, the S&P had its largest one-day loss in 6 months this past week. All right, it's on its way to like that. We had our 3 weeks in a row of losing weeks. This is a worst day in 6 months, but worst week since March. Right, so just really not a good time for the markets. In addition, about concerns to higher interest rates, we got worries that are weighing on the market. We got the impact of this UAW auto strike, potential U.S. government slowdown. We got some of these things playing themselves around, and not to mention higher oil prices. I'll also note that from August to October, over the past 95 years, we've seen volatility on average spike about 27%. Now, our members, I've been getting our members into deep out of the money puts for the past couple of weeks. They've been very cheap, and for our members that did that, they've done very well. Meanwhile, our strategies are still holding up fairly well. We should beat the indexes this year, certainly the S&P, on annualized performance. But you can see here the PE ratio in the upper right-hand corner. It's still rich. It's at 19.86, slightly lower on the 12-month forward than the trailing, but still a little bit higher than I would like to see. 10-year Treasury, fours across the board, high. All right. 285 basis points higher than the dividend yield in the S&P. The earnings yield is a healthy 5.12%. And the yield over the 10-year Treasury is about 68 basis points. But the real yield, which is important, is 152 basis points over inflation. So that's not that bad because inflation's coming down, although you can see here this past week the VIX closed at 1720. The prior week it closed at 1379. So we had about almost a 25% hike in VIX just over this past week, which would kind of come in with what I was talking about. On average, we've seen volatility spikes of 27% from August to October. So we almost did that in just this 1 week. Best performer for the week was healthcare. Worst was discretionary, as you can see on the screen there. Annualized performance so far year to date, communication services just slightly under 23 or 24%. Utilities bringing up the rear around 22%. Okay, but as expected, the Fed's left its short-term rate in the target range of 5.25 to 5.5%. Right, that was the level that they set in the previous meeting in July. But in an updated summary of economic predictions, that's their dot plot. They continue to show the possibility or the likelihood of one more rate hike in 23. Now, remember, we do not have a Fed meeting in October. Well, officially, they start the session the last day of October, but then the first day of November is when we get the potential rate hike in November. And that would be the last potential rate hike the Feds would be looking at should they hike. But what really surprised the markets more than that was the dot plot in 2024. The markets were expecting 4 rate cuts next year. Feds only had penciled in 2 rate cuts. So that spooked the markets. That's 50 basis points higher than the markets thought. So we're going through a revaluation using discounted cash flow models, most big money players, hedge funds, mutual funds, and things. And that just calls for PE ratios to come down. You can see the forward is fallen below the trailing PE ratio on the screen there. I think it's got a little bit more ways to go. All right, and with all of this hike in rates, we're seeing that and short-term rates are probably going to be higher for longer. The 10-year Treasury yield hit a 16-year high this week at right at about 4.5%. And it's interesting to note that some guy did a study going all the way back to 1790. I know none of you were trading back then. The average rate for the 10 years 4.5%. So we're right at average, I guess. But anyway, that's kind of what I'm showing on the screen here. If we switch over and let's take a look at the European markets, you can see in Europe, everybody was in the red, kind of following suit with the U.S. Euro stocks, FTSE, CAC 40, DAX, all of the big major indexes across there, solidly in the red. Year to date, everybody's in the green in Europe. Bank of England this past week voted just barely 5.4 to keep their rates unchanged at 5.25. All right, as they're seeing inflation come down there as well. And keep in mind, that was the first pause for these guys since December of 21. I think they've had like 14 rate hikes in a row. And the Bank of England Governor Bailey basically said that borrowing costs could rise again if there's evidence of more persistent inflationary pressure. So basically, he's saying the same thing all the others are saying, whether it's Christine Queen Bee Lagarde at the ECB or Boom Boom Powell at the Fed. You know, if they see inflation staying sticky or moving up, they're not going to hesitate to raise the rates a little bit more. Okay. So we're seeing inflation in the UK slowing to 6.7%. I think it's the highest all across Europe, higher than where we are here as well. So that's kind of what we've got in the UK. And then if we look at the Eurozone, we can see orders, factory orders dropped the most in almost 3 years. Their private sector output has contracted 4 months in a row. And then their seasonally adjusted Eurozone composite PMI, which combines both services and manufacturing, even though it was up in September, just barely, it's still at 47.1. So that shows contraction across the Eurozone. So that's why, you know, and I'll show you the currencies in a minute. The dollar is so much stronger than the euro right now. And then, of course, we go across to the Asian markets. You can see Nikkei, China, Hang Seng. If we start with Japan first, it was in the red for the week. Green, solid, but neck and neck running with NASDAQ here in the U.S. But they continued a monetary policy divergence from the hawkish Feds here, right? That's why the yen is like at 148.3 against the dollar. That's very, very weak. Now, that's around the area where the Bank of Japan pretty much intervenes to get that yen a little bit stronger. We'll see what they do. Members, I'll go through with you again what I like as a trade around the yen. Now, at their meeting this past week, they pretty much kept their short-term rates at a minus 10 basis points, and the 10-year government bond right around 0%. And we see their CPI is at 3.1% year over year. So that may seem low to most, but in Japan, that's that's a miracle. So they got it a little bit higher than consensus here. They want to keep inflation hotter for longer in Japan. But Japan and China are the only two countries that are putting stimulus into the economy rather than taking it out. And speaking of China, it was the only lone green on the screen of major indexes globally. You can see it was up almost 0.5%, 47 basis points. They pledged to accelerate measures to consolidate their recovery and supporting growth. So let's put more money into the economy. And China, is just as a side note, recorded capital outflows of almost 50 billion US dollars in August. That's the largest since December 2015, right? And that helped push the yuan to a 16-year low against the dollar. The dollar is the only game in town right now. And not only that, China used to grow at 7 to 10% a year. Well, most economists see future growth at China around 3 to 4%, which is about half of its growth rate, as I said, for the past decade or so. Keep in mind, China is still a top trading partner with 120 countries, but many of them are lessening their imports from China. So China's exports are falling dramatically. As I think this current globalization supply chain reset is continuing to unwind. So we'll see how that plays itself out. What I want to do is shift the screen over and let's go take a look quickly at the charts. Now, let me just move this around here a little bit. Let me just see if I can get you on the screen here. So it's going to take about 15 seconds to get you up on this screen. So, and if we look at it, you're going to see here uh, what you're looking at is the S&P 500 E-mini futures. All right. And you can see here that we hit my target over here, and then you can see at 43.50. If we move below 43.50 on the futures, then we're going to take out the low that we made over here on August 18th. I believe we will. We've hit my targets fairly accurately. We've gone back below the 50 EMA. We're sandwiched between the 50 and the 200 EMA. And you can see the my projection now is calling for it around 42.75, just slightly south of 4,300, which is just slightly north of the 200. Excuse me, the 200 EMA, which is sitting at about 42.65. Okay, so that's kind of what I'm looking at right now for the markets. I don't think we're done yet, but it's not like a terrible, terrible move lower. I do see going through the end of the year, moving back up, maybe taking out the highs that we made on July 27th. You can see I've got a target here, a year-end target of around 46.92. Our all-time high is at 48.08, so we're not going to touch that this year, not unless I see some changes dramatically in economic data as well as what the Feds are doing. But as long as the Feds keep the rates higher for longer, and that's the perception that the markets have, you're just not going to see a lot of upside catalyst momentum or catalyst to drive the momentum, get that escape velocity to come up here and make new all-time highs, right? Now, if we look at the NASDAQ, you can see here with the NASDAQ, it also has blown below the 50 EMA. We're coming near my target, near-term target. Further term target for NASDAQ's around 14,000, right? It's further out in time, about the middle of, towards the end of October. Remember, higher rates are just really not good for technology. And you could see this support zone right here. In fact, what I'll do is I'm going to move this up. This would be more believable for me. Right there, about 14,609. We take that out, and we've got kind of a railroad track here because we also had a gap here, right in that one right there. So I could see this providing support, which would fall in range with where I think we can pull back to, but the middle of the range is about 14,000. So that it makes sense to me on NASDAQ. And then, of course, if we look at the Dow, you're going to see the Dow is it's hitting both my short-term and longer-term target. I don't think the Dow is going to go that much lower. I see support down here at the 200 EMA, sitting around 33,900 roughly. But I don't see us going much lower than that. I do see us staying over the 200 EMA. So unless we get some really shocking economic news, I don't see that. And if we look at the Russell, you can see the Russell is just barely in the green year to date. We've blown through both the 50 and the 200. This is a very ugly chart, right? The 50 is still above the 200, but it's a very, very ugly chart. And we were up here around 2017, just back on August 1st. And we've fallen dramatically in a very short period of time, from August to about the end of September, 2 months. And that just kind of encapsulates what I was expecting for August through October, right? So that's a little bit of what I see here on some of these major indexes. And of course, if we look at volatility, if we look at the front month vol skew, we're contango, meaning a normal term structure, but just barely. And if we look at the back month skew, you can see right here, again, a contango, but not by much, right? Now, if we move into a backwardation, meaning the backdated vol futures is higher than the front dated, the front dated is higher than the backdated, sorry, then we're going to see a little bit more turmoil in the markets, and the VIX is going to explode much higher, okay? Right now, it has not. If we look at the VIX, it's fairly under control. I mean, yeah, we've blown up here, but it really hadn't, I see kind of an overhead limit of around the low 20s, what we made back over here in May timeframe, but I don't see much more than that, right? So that's a little bit about what I'm seeing here. And of course, if we look at treasuries, you can see the bond market is pretty low, right? I mean, we're way down in this level down here. We're hitting the 2022 lows was here. We're lower than 2022, which then means, September 22nd, right? Right around the Fed meeting date on Friday, though, down 7.24% in bonds, which then means the 10-year rates are a lot higher. And if we look at the rates, you can see here that they're up 16%, the rates. The high was on September 21st, right? The day after the Feds. And you can see where we're sitting right now. Now, my longer term high, believe it or not, for the 10 years up around 5%. Markets are not going to like that, the equity markets. And if we start continuing to climb up and we keep this momentum up, you're going to see a steady downbeat on the equity market. So we got to pay very close attention to what the interest rates are doing here. And then you throw on top of it the UAW strike, a potential shutdown in the government. That's going to make the kickoff of October a possible ugly one. All right, so we just have to watch very closely. If we look at the US dollar, it's the only pig in the pen with lipstick right now. And you can see the dollar's just been on a tear since the July 18th low, right? And now we're well into the green. 50 is probably going to cross the 200. We're on an Elliott wave 3, which does suggest any pullback should be bought. And the euro, we had two great long trades in the euro last year. Now you can see here that, well, it's just not going to happen. We're back in the red again for the euro, right? I want to go long the euro. I think longer term it'll be a good long-term trade, but right now you want to either be short or not into the currency market right now. Things need to settle down. There's a lot of ambiguity in the air on just where the interest rates are going to go. And Boom Boom Powell with the Fed here has basically given him the option to go left, right, or center line, which, the market's trying to guesstimate what does that mean? Where is it going to be? Very difficult to do. And then, of course, a trade that we're all going to love here soon is the yen. You can see the yen is coming down and hitting my price target down here. I think longer term, we're going to want to be long the yen. Members, we'll go in a little bit more detail on it, but just a great trade, I believe. Okay. And then, of course, if we look at metals, gold is just, we got a good trade for gold. It's not a directional trade right now. It's just up, down, up, down. It is not worthy of it. In fact, I'm looking at gold to go even lower from where we are right here. I've got a target much lower down here around 1850. I don't know if it'll get down there, but I just don't see gold as being anywhere bullish right now. And copper is kind of running sideways. It goes where China goes. You can see this regression channel here. It's just kind of been staying inside the regression channel. Every time we try and break out of it, you can see the 50 EMA getting ready to break. It'll probably break on Monday at open, and that would suggest more downside for copper, right? Which should be, because China is having a hard time of it, right? Then, of course, if we look at energy, oil is up. Clearly, it's strong. You can see here oil, the high price for oil was on September 19th, up 16.43%. I've told my members this has been my target for oil this year, 95.65. And we came in at about 93.90, almost 94, right? So that's a little bit about my where I'm looking at oil. I think any dip here is probably still going to be bought. There is no divergence in the oil markets on the technical indicators. So you got the 50 over the 200. You got a lot of support underneath here. So I'm more bullish than I am bearish. Nat gas, same thing. We got great trades running in nat gas. You can see the regression channel in this. Back over here, we started getting into it in middle of April, early May. Just a good trade. All right, members, I'll review it with you guys again on best ways to play that thing. Okay, and then of course, if we look at gasoline futures right here, you can see it is pulling back, which should be good for folks at the pump. But with oil staying high, it's going to keep an artificial put underneath and stay a little bit bullish for a little bit longer. All right, everybody, that's a little bit about where we're sitting right now in these markets. Members, I will see you Sunday evening for our weekly market watch. Otherwise, have a really great weekend, everybody. Ciao, folks.